They were featured a very low start rate, and they would allow a homeowner, a borrower, to pay either the minimum teaser rate, to pay an interest-only rate, to pay a fully amortized rate or payment. And unfortunately, in a lot of cases, the borrowers chose that teaser rate or the interest-only, and in fact, most cases, the teaser rate. And what that did is it created negative amortization. What does that mean? It meant that interest wasn't being covered by the payment. It was adding to the balance, and the balance was growing. So that, along with some of the other very short-term 6-month adjustables, 1-year adjustables, is considered to be a reason why we had the Great Recession, that property values fell, a lot of homeowners were underwater in value, and they weren't able to make their payments. So coming out of that disaster, ARM loans kind of fell out of favor. And the industry kind of went back to work on designing a better adjustable rate mortgage that would have better features and be safer for borrowers. And out of that came what we called hybrid ARMs. These are ARM loans that are adjustables, but they have features that are somewhat more like a fixed rate loan. We would sometimes call them fixed ARMs. And so that's what was happening after 2008, the development of these hybrid or fixed ARMs. And the most popular of these would typically be what we call a 5, 7, or 10-year ARM. In fact, they would typically be called a 5-1, a 7-1, or a 10-1 ARM. And with these loans, your initial rate and payment would be fixed. Like a 5-1 ARM, you'd be fixed for 5 years. 7-1 ARM, you'd be fixed for 7 years. 10-1 ARM, you'd be fixed for 10 years. So that provided a lot more flexibility. Well, actually, it provided a lot more safety to the borrower because they were assured of having a fixed rate period for an extended period of time. Now, in most cases, and I would always counsel my borrowers who are interested in an ARM loan, and again, why would they be interested in one of these ARM loans? Because generally speaking, the interest rate would be lower than your available 30-year fixed rate loan at the time. And the amount that it would be lower by would depend on the fixed rate period. In other words, the 5-year ARM would generally have the lowest discount or reduction in rate over the 30-year fixed. 7-year ARM a little bit higher, 10-year ARM a little bit higher still, but all three options would still offer a rate below a 30-year fixed rate loan. And in a lot of cases, when a borrower is buying a home, they may have some reason to believe they may not need the loan for 30 years. So they would pick the ARM loan for an obvious logical reason. Why not take advantage of the better rate when you know that you're not going to keep that loan past the fixed period? So that was sort of the foundation of why many borrowers would take this kind of loan, is because they wanted to enjoy that lower rate, lower payment, because they had a pretty good idea that they weren't going to keep that loan past the fixed period. And in fact, there's some data to basically support that, because the average loan, certainly in the U.S., if not, and certainly in California, is about 7 years before they're paid off, whether because of selling a home or refinancing. So that was really the reason why, even after the collapse of the economy and the mortgage market in 2008, because of these more risky ARM loans, even when we got these hybrid ARMs, they were safer. And so in some instances, they were still chosen by the borrower because they had a pretty good idea that they weren't going to keep it past the fixed period.
Well, it seems to me that, Art, that's a pretty safe bet. As you said, we move in and out of our homes, or certainly with the loan product, it kind of goes back to that whole thing of, you say, marry the house, date the rate.
Yeah.
It seems to make good sense when you say, well, we're thinking, I've got 5 years before I retire, or 7 years, or I've got a contract and I'm gonna move after that. It seems like a pretty good deal, but there's a lot of folks now that are thinking, hey, I need to decide what I'm going to do here because they're coming due.
Well, here's what's happening. Again, this hybrid ARM had become, after the Great Recession, the most popular option for ARM loans. In a lot of cases, they've worked out fine. But you got to think of there's a couple things to think about. One is the initial rate on the loan is more or less an arbitrary rate. In other words, it has some connection to how the rate on these loans is actually determined when it starts adjusting. In fact, let me touch on that a minute. After the fixed period, These loans would adjust typically every 12 months. And they're going to adjust based on a index and a margin.